Greetings, this will be a continuation video of one I posted a week ago because these are very pivotal times in the stock market and there's a lot of demand for guidance on how to interpret market dynamics, and therefore while there's going to be some repetition in this video relative to last week, there are a lot of new developments to consider in the elapsed time. So for those of you tuning in for the first time, I have a lot of expertise in investment and stock market reading and technical analysis, and I have called various market turning points a number of times, and those are time stamped across my social media and my blog. One in which I called a generational bottom in the stock market and the appropriate level during the COVID-19 crisis is in this tweet right here with the timestamp in March 2020. This is a tweet that I made on the Twitter platform, and this was on March 22nd, 2020, so in the midst of that very steep COVID-19 market crash. I said the exact stock market bottom is impossible to call, but the S&P 500 at 2250 or lower from this point on is one of the best entry points you'll ever see in your lifetimes. Trillions of dollars of QE have been done worldwide, read the Atom publication, and this turned out to be correct. 2250 or lower in March 2020 was just about the best entry point anyone could ever see in their lifetimes, and you will probably never get something that is that poised for a rise from that point, so this call was very accurate. I have a whole bunch of other time-stamped stock market predictions that I'll go over in other videos, but this is just one, and the reason I'm citing this one, which is in the description box below so you can look at it as well, is that now we're entering a reversal of this particular barbell, let's call it, the other side of the barbell. So almost 2 years later, 23 months later to be almost exact, we are going to see virtually the reverse. And I have other timestamps like that one that I'm going to archive and go through in some other video on this channel in the future. But for now, the more pressing matter at hand is that a very classical topping pattern is forming on the S&P 500, and the last week of events has not done anything to change that outlook. If anything, it has strengthened that outlook and has given cause for caution over here. And that is known as a head and shoulders pattern in the S&P 500. So this is a one-year chart of the S&P 500. It made one high, a small correction, and then it makes another high that seems to meander for a while. And so this becomes known as a head, and this is a left shoulder. And then it corrects down to what is known as the neckline over here. It doesn't break through the neckline, it rebounds back from that, but the rebound is very weak. It appears to have no chance of getting anywhere close to making a new all-time high, and appears weak and downward trending. And this is known as a head and shoulders pattern, which is one of the classic indicators of a very long-term stock market top. And this is the one-year chart. If we go to the 5-year chart, you see this big run-up in the stock market based on the Federal Reserve's rather drastic starting and stoppage of quantitative easing. Now, as longtime viewers know, I recommend a steady stream of quantitative easing that is very transparent, that is in the form of cash sent directly to people, so that you don't have this hyper distortion through the purchases of treasuries and mortgage-backed securities, which distorts those sectors and keeps capital from flowing where anyone else can benefit from it. So working class Americans are not benefiting from this at all, except in the most indirect of indirect ways. After it's circulated around for 6 years, maybe it percolates down to the working class and other poorer Americans. Separately, one always has to take a worldwide view of quantitative easing because technological deflation is borderless, and the monetary creation, the QE that offsets it, is also borderless, as I often speak about. But the U.S. stock market tends to react very disproportionately to what the U.S. Federal Reserve does, even though the S&P 500 companies are very global in nature. Over time, these discrepancies will adjust, but at the moment, when the Federal Reserve of the United States starts quantitative easing, there will be a bull market, and when they stop quantitative easing and, even worse, raise interest rates under a misguided fear of inflation that never seems to arrive for any sustained period of time, then you have market crashes. So in this 5-year chart, you see this general run-up, and then this bottom that I called, and a huge run-up since that time, more than a doubling of the S&P 500 in less than 2 years. And this head and shoulder pattern, the left shoulder, the neckline, the head, correction to other neckline, and this other shoulder forming. This pattern alone indicates a large chance of a correction down to perhaps the 3,000 level should not surprise anyone. It can also overshoot, of course, and go well below 3,000, but at the moment, a correction down to 3,000 would still be in line with this general megatrend. And that is something to keep in mind. If you have a lot of equities and you think that your current gains are good ones and you want to sell, that is something you can consider. Now, don't do anything just because you saw this video. I am just helping you think through these various market dynamics so that you come to your own conclusions. Remember, when you sell stocks, if it's not in a tax sheltered account, you take a tax hit as well. So you cannot buy the same stock index the next day because you have to owe taxes in between. And those are other factors to take into account. But based on this pattern alone, there appears to be all sorts of signals of how the S&P 500 is going to correct down to this level, and that's a lot deeper than a lot of people think. People think that the correction that already happened is the correction. No, that was not the correction. That was just a warning shot. The bigger correction could very well be yet to come. Now, this is just a technical analysis of the S&P 500. There's also the speed at which the Federal Reserve is wrongly tightening and not only stopping quantitative easing, but raising the Fed funds rate, which they will be quickly forced to reverse when the stock market correction causes a recession. All the inflation that they're talking about is much more reduced. And even if there is inflation, they still will have to do quantitative easing just to stimulate the economy because millions of jobs will be lost. Now, what is particularly dangerous about this period is there is some inflation due to governmental mismanagement. The United States has discouraged domestic oil and natural gas production. That has caused the prices of those things to rise, which has caused some domestic inflation, which then the Federal Reserve, not knowing any better, interprets as a need to swiftly and excessively reduce quantitative easing, and therefore you're going to have a lot of turmoil and a lot of ordinary people are going to suffer a lot. Now, to measure the speed at which the Federal Reserve is tightening, we go to something called the Wuja shadow rate. This is the same material repeated from last week, but it's very important, so it's not a bad thing to see twice. And if you're new, you're seeing it for the first time. So we go over to that clip in part 2 of this video. This is an obscure economic measure known as the Wuja shadow rate, and it's done by two people that you've never heard about, and very few people even know about this or look at it, but it is an approximation of quantitative easing's effect on simulating a negative Fed funds rate, because the Fed funds rate can only be lowered to 0, but then quantitative easing was done to simulate the effect of a negative Fed funds rate. We had a positive Fed funds rate all the way until 2009 when quantitative easing began, and now this green line has diverged from the blue line, because the blue line is the official Fed funds rate and the green line is the additional negative reduction from quantitative easing. The green line is never above the blue line, but it is below the blue line when the US is doing quantitative easing. Now again, this is a US only metric. It does not take into account the worldwide quantitative easing effect, because the US only does 25% of the entire world's total, as I speak about virtually every month. Now look at how steep a rise this is in the Wuja shadow rate. We had the quantitative easing due to COVID-19, and that still only got us to this minus 2% or so Wuja shadow rate. So not even the all-time low that we saw in 2014, but only a partial low. I believe the broader long-term trend is negative because of the exponential deflationary effect of the atom. So the amount of QE that should be done should put us at minus 3% or so, just as an equilibrium. Yet the Federal Reserve is tightening. They are tapering their QE very, very fast, and they are about to raise the Fed funds rate. They're going to raise it in March, and then they're going to raise it after that until there's a big stock market crash when they're forced to do QE again. And they just don't understand that they're never going to get to this 3% Fed funds rate that they consider to be normal. They still talk about normalizing rates. I criticize that outdated ideological belief system in this video up here that you can look at from about a month ago. But they are tightening when they should be respecting this downward trend. There's an old saying of don't fight the Fed, and I agree with it. When the Fed is tightening, expect a stock market crash. That head and shoulders pattern is already forming. But at the same time, the Fed is fighting nature. They're fighting the first principles of the universe, the principles of the connection between technology and economics, because they're tightening again. And every time the Wuja shadow rate got too high, there was a large market crash, and they just had to print more. They keep thinking that they're done with quantitative easing forever, and they can raise the Fed funds rate to 3%, when no, they're going to be forced to go lower and respect this downward trend that is very evident and manifesting. Quantitative easing began when it did because a 0% Fed funds rate was kind of normal. This trend goes back all the way to 1990. And this is the very beginnings of sufficient technological diffusion in the economy as to create a high-tech component that was distorting traditional stats. Now, economics textbooks are still decades behind the times, so they can't figure this out. That's why they're tightening. They should not be tightening at all. Whatever inflation they see is because of governmental mismanagement. It is not because of monetary policy, yet they are clamping down monetary policy because of governmental mismanagement, causing a stock market crash, causing a recession, and that will not improve governmental mismanagement at all unless people organize and start to take more political action in a way that forces governmental accountability. And that could take a long time. So now you see this really sharp upward spike in the Wuja shadow rate. That is a much faster taper and tightening than has ever been done before. Even this large tightening, which they of course had to reverse from 2015 onwards, that caused two market crashes, 2015 and 2018, and a very slow market period between those 2 years. But now they're tightening even steeper than before and about to go positive. And they think, like I said, that they'll go all the way up to 3%. I don't think the stock market and the economy will let them go that high. But this is another big indicator of market crashes being imminent in the not too distant future. And whether it is tomorrow or whether it's 3 months from now, we don't know. But as I've said in other videos, at some point between this February and August window, so when you consider this Wuja shadow rate rising rapidly, an artificial action that is going against the first principles of nature, and that head and shoulders pattern that we're seeing in the S&P 500, those are two of the big indicators to look at. Now, again, no indicators are 100% perfect, and I'm not telling you what to do. This is only so that you can look at various indicators to help you form your own conclusions. I'm not responsible for anything you did or didn't do, or any trade you made or any trade you did not make, because this video is going to be useful even years from now, because I want it to be instructional about when to look for these things. I don't want people to necessarily do something tactical short term that you weren't otherwise going to do unless you have come to your own conclusions. And even after the market crash, this video will be of an evergreen nature for instructional purposes. But the date of this video is important because we're looking at the market charts and the Wuja shadow rates of this time. So you go back to the stock market chart. So that was the Wuja shadow rate. Now when you combine these two factors of a head and shoulders pattern very distinctly forming on the S&P 500 and a severe clamp down of QE away from the gradient of what normal QE flow should be, then you have a cocktail that is very, very bearish for the stock market, at least relative to these levels. Quantitative easing should not be stopped at all. I say that it has to rise at 16 to 24% a year, and I speak about that in my monthly Worldwide Monetary Creation update videos. You can see the latest one in this card up here. But the problem is that they don't take a worldwide view. They still think that the normal rate for the Fed funds rate, and therefore the Wuja shadow rate, is 2.5 to 3%, whereas I say it should be -2 or -3% right now, as I said earlier in this video. And the Federal Reserve is going to be forced to reverse its excessive quantitative easing. Now, the thing that makes the situation rather bad is that there is some inflation due to governmental mismanagement. This has nothing to do with the Federal Reserve, but the Federal Reserve is then throwing the baby out with the bathwater, so to speak, by stopping quantitative easing rather than saying that, hey, this is because of governmental supply chain mismanagement and because of the government discouraging U.S. production of domestic oil and natural gas. The Federal Reserve should not clamp down the entire economy because of the government's mismanagement of the supply chain of one or two sectors. No, because then you have both a recession as well as a stock market correction without the governmental mismanagement situation being corrected at all. That's when things could get pretty bad. So anyway, this information I hope is informative for you. Now again, don't make any decision or do any trade or not do any trade because of something I said. This video is not merely meant for the current time. This is a video that will be useful a year from now, 2 years from now, because I aim to teach people about how to observe various market predictive indicators beforehand. So don't just react based on this, and I'm not responsible for any gains or losses that you make from anything you do over here. This is an instructional video meant meant to be of an evergreen nature and useful years from now, even long after this correction has come and gone. But the events of the last week have done nothing to reverse the assessment of how this is a head and shoulders pattern forming, and the Federal Reserve is continuing to tighten. In fact, in March, they are going to continue to tighten more and more. If you have a long-term outlook, maybe you don't have to do anything at all. We are in a steeper gradient of the accelerating rate of change, and index returns will continue to get higher and higher in terms of a trend line. There are times when we are above the trend line like we are now, and there are times where we swing below the trend line. But if you're a young person today, you're fortunate to be born in this era because you are born into an era of steeper gradients of investment returns. Your father and grandfather may have had 6 or 7% a year return expectation, and you can have a higher percentage a year expectation than that because of how much closer you are to the technological and therefore economic singularity. But for now, the short-term considerations regarding the stock market are things that are too immediate and too granular for the long-term trend lines to be the primary factor in assessment of what an investment strategy should be at this particular time. So I hope everyone can use this information to think through what they want to do and come to their own conclusions about that. If you found this content to be informative and you like this type of instructional material, then I encourage you to upload this video and hit the notification button as well as subscribe to this channel. Thank you very much for watching.